So yes, we have referenced effective dividend yield a few times on the podcast, but I did receive a question from a listener asking us to break down what the effective dividend yield of a stock is and how an investor would calculate their own effective dividend yield on a stock in their own portfolio. Now, this will be review for most podcast listeners, but first we need to describe what the current dividend yield on a stock is and how to calculate it. So the current dividend yield on a stock is what percentage return in the form of cash dividends an investor would receive when purchasing a yielding stock at the current market price. And we usually quantify dividend yields in annual terms for comparison purposes, so just keep this in mind. So using a real world example on Dynacor, the current dividend yield on the business is about 3.9% because the stock currently trades at $3.04 and pays a monthly dividend of 1 cent. So considering Dynacor is expected to pay us about 12 cents in dividends over the next year, the dividend yield on Dynacor is the 12 cents divided by the $3.04, the current price, which equals 3.94%. Now, the effective dividend yield, on the other hand, is the percentage return in the form of cash dividends an investor would receive based on the initial purchase price that they paid. So this is the defining difference where normal or current dividend yields are based off of the current share price, whereas the effective yield is based off of the price we actually purchased the stock for. And the effective dividend yield becomes ever more important to focus on for dividend growth stocks as the price one pays for the stock never changes, but the dividend increases, amplifying your effective dividend yield earned. Now, for example, I put together this little table here. I personally purchased Dynacor at $1.80 on July of 2019 when it paid a current dividend yield of about 2.2%. But since then, the company has increased the annual dividend from about 4 cents per share to 12 cents per share. So rather than calculating the 12 cents divided by the current market price, I would simply take the current dividend of 12 cents divided by the actual price that I paid for the stock or for the share of the stock to get my effective yield. And thus, if we take the 12 cents divided by the $1.80, which is where I purchased the stock at, my effective yield that I earn on Dynacor every year is about 6.7%, much higher than the current dividend yield of 2.2% when I initially purchased the stock. And that's because, we've seen the company increase its dividends over time. So that's really, a big takeaway here is, it really, you want to calculate your effective yield if you are in a dividend growth stock, because that price that you paid to initially buy the stock stays the same, but those dividends that you earn each year are growing and increasing your actual effective yield. Bada boom, bada
Yeah, and
boom.
then the flip side to that is that, there's also the opportunity cost, right? So when you're looking at current yield, you're comparing, should I stay in this company at a yield of say 3.94%, or should I buy something else? Because you can take that capital appreciation, the share price has moved up, you can take that extra capital. Theoretically, then you can move that over into another stock that is paying, a different yield. So there's opportunity cost. I mean, if you're looking at opportunity cost, that's when current yield is more relevant. When you're looking at, your own returns, that's when effective yield is more relevant. But of course, even, when talking about moving the capital to another stock, that doesn't take into account any tax implications there too. So it can get a little more complicated.
For sure.
Yeah. A good breakdown.
So in the case of a company like Brookfield, like the effective yield at this point would be getting close to 30% likely, right? Because of the dividend yields.
I believe I calculated, it was around 25% or something like that.
I mean, we recommended it in 2011, and you'd basically on
every year on the dividend.
So every dollar of capital that was invested back then would be getting probably about a 25% yield right now. Right? But the stock is yielding at the current price. The stock is yielding about 4%, like 4.2%. Yeah. So if I'm comparing this to another investment and deciding should I keep my money in Brookfield Infrastructure, should I move somewhere else, then the current yield becomes relevant. If I'm looking at how well I've done over the past 11 years or so, then the effective yield. So the point being, you can look at both, right?
Yep.
Yeah, for sure.
Certainly.